An investment advisor in Pennsylvania used his client's money to buy a share of a miniature golf course. That is according to a complaint the SEC filed on January 17, 2025. It also lists country club dues and credit card debt. The advisor was Scott J. Mason of Gladwine, Pennsylvania. Per that complaint, he misappropriated client funds from at least 2014 to 2024. 10 years. That timeline raises the question at the center of this case. How does an advisor keep taking client money for a decade without the kind of financial collapse that exposes so many other schemes? Mason operated through his advisory firm, Rubicon Wealth Management LLC. An investment advisor owes his clients a fiduciary duty. In plain language, he has to put their interests ahead of his own. Rubicon was the vehicle through which Mason advised clients and handled their money. The paperwork said one thing, the money went somewhere else. The distinction between a Ponzi scheme and straight misappropriation explains why this story developed differently. A Ponzi scheme uses money from new investors to make payments presented as returns to earlier investors. Its dependence on continuing inflows creates pressure. Payments must continue, and a shortage of new money or a surge in withdrawals can expose the structure. Straight misappropriation is simpler. Money entrusted to a fiduciary leaves for an unauthorized purpose. It doesn't need a growing supply of new investors. There are no promised returns to fund. That removes the built-in collapse pressure a Ponzi carries. This kind of fraud continues until the transfers or the concealment are uncovered. One client's account stretches the record back further than the complaint's 10 years. According to the Justice Department, the conduct involving a single long-running client began in 2007. The Justice Department also says Mason used fraud proceeds to partially repay that victim in order to avoid detection. Those repayments were netted against what he had taken. What remained, per the Justice Department, was a loss of more than $6 million for that one client. Measured from 2007, the documented conduct runs 17 years. And those partial repayments carry the one feature usually associated with a Ponzi: incoming money used to satisfy an earlier obligation. Everything around those repayments was money moving one way out. The SEC named 3 defendants in its case: Mason, Rubicon Wealth Management, and Orchard Park Real Estate Holdings LLC. According to the SEC's release, Orchard Park was one of Mason's entities, and client money was transferred directly into accounts it held. That is the basic plumbing described by the regulator. Funds moved from client accounts into an advisor-controlled entity, and the SEC's complaint alleges the uses were personal. Years of those transfers produced a criminal case the Justice Department summarized as the defrauding of clients of more than $23 million. A separate consequence accumulated through Mason's tax returns. Fraud proceeds are taxable income under federal law, even when the recipient had no lawful right to the money. An unreported theft therefore creates a second federal exposure sitting on top of the first one. According to the Justice Department, Mason failed to report the fraud proceeds on his personal returns. Prosecutors calculated an approximate tax loss of $3,225,000, so the same diverted money appeared in the criminal case twice, once as proceeds taken from clients, and again as income omitted from Mason's returns. The IRS would end up in the judgment as a creditor alongside the people whose accounts the money came from. In January 2025, federal prosecutors in the Eastern District of Pennsylvania charged Mason by information. An information is a criminal charging document filed directly by prosecutors without a grand jury indictment. Mason pleaded guilty later that same month. According to the Justice Department, the charges were 2 counts of wire fraud, securities fraud, investment advisor fraud, and 5 counts of filing a false tax return. The case ended in a guilty plea without a trial. At the same time, the SEC pursued its parallel civil enforcement action against Mason, Rubicon, and Orchard Park. The criminal and civil cases addressed the same core conduct through different legal channels. According to the Justice Department's sentencing announcement, United States District Judge Timothy J. Savage sentenced Mason, then 66, to 97 months in prison on June 25, 2025, followed by 3 years of supervised release. 97 months is more than 8 years. Mason had operated through an advisory firm entrusted with client money, moved funds into an entity he controlled, and admitted guilt to every count filed against him. The criminal judgment converted that record into a prison term and a set of financial obligations that outlast it. According to that same sentencing announcement, the court ordered Mason to repay $24,998,596.46 to his fraud victims. It also ordered more than $2,300,000 to the Internal Revenue Service. The court did not round the victim figure. It is a computed total carried out to the last 46 cents. The two obligations are distinct and they track the two sides of the same diverted money, what left the client accounts and what never showed up on a tax return. Mason carries both through his prison term and the 3 years of supervision that follow it. On December 19, 2025, the SEC issued litigation release 26,451, reporting that final consent judgments had been entered on December 12 against Mason, Rubicon, and Orchard Park. The defendants were held jointly and severally liable for $17,734,515.69 in disgorgement, plus $4,913,428.60 in prejudgment interest. Joint and several liability means the SEC could collect the full amount from any one of the three defendants. Disgorgement measures what the SEC calculated Mason took in, not what the criminal court ordered him to repay, which is why the two figures differ. The SEC release says that civil obligation was deemed satisfied by crediting the criminal restitution and forfeiture orders already entered. In practice, the civil judgment was resolved against money the criminal case had already put on the books. There is no discovery seen in this case. The SEC's releases and the Justice Department's sentencing announcement never say what triggered the investigation. What they do document in detail is concealment. The SEC says Mason forged client signatures. It says he provided fake account statements and fake tax documents to go with them. And according to the Justice Department, Mason represented that client money was being placed in diversified short-term bonds, a conservative description of where the money supposedly sat. The Justice Department also says he used fraud proceeds to partially repay one long-running victim, specifically to avoid detection. Put those together and you get a full set of appearances. The appearance of authorization because the paperwork carried a signature. The appearance of an account because a statement arrived showing a balance. The appearance of a strategy because the money was described as sitting in safe bonds. A client who checked all three saw a working portfolio. The mechanics of this fraud were paperwork, representations, and access. Nothing about that structure was ever going to break on its own. A Ponzi runs on a clock. Straight misappropriation has no clock. It ends when someone entitled to look at the paperwork actually looks. The 10 years in the SEC's complaint are a measure of how long that took, and the last image the record leaves you with is almost absurdly modest. Client money routed through a wealth management firm arriving at a miniature golf course. The SEC and the Justice Department publish filings like these every month, and I read them so you don't have to subscribe if you want the next one.